Okay, let's get to it. Bowen. Sadly. Charles. Chisholm. Christian. There we go. Contreras. Curl. Eater. She's here. Oh, I'm sorry. No. Ham. And. Oh yeah. It's actually I'm hoping that it helps identify, like, oh, he's there. Lee, I know you're back there. I saw you. Linders. McClure. Navarro. Quintero. Ramos. Carissa Rodriguez. Giovanni Rodriguez. Silvestre. Simpson. Bork. Von Henkel. Okay, got him. Walker. And Wilson. Beautiful. Okay, so I'll start off with the general. I'll start off with the general announcements and information, and then we'll dive in. We've got a little bit of a fire hose today to go through the rest of this. I'm going to throw it up on both screens, make it easier for folks to see. I cleaned up Moodle a bit this morning, so I took the stuff. What you see on Moodle is really there's two components. There's one that's recordings and information from the class, the same class that was taught at JBLM last spring. I've slid all that up to under the first weekend announcement section so that it doesn't kind of get messed in with the rest of the stuff. So you'll see class after class after class after class of PowerPoints, 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 PowerPoints. They're there for your use and reference. The recordings are, in some cases, going to be in a little bit better shape than the one that we had last class. But if you want to look at information as it pertains to the class, you're kind of twisted and want to watch the class over and over and over again, you've got not only this year's classes, which I'll record as we go, and the first one is now up on Moodle, the link to YouTube, but also prior year class that you can go in and kind of pull out sections of the classes to look at. So I know I've got a number of student athletes in here who are going to have already started or will be starting seasons. And so that's a good way for you guys and gals to stay up to speed on what's going on in class, because those will be excused absences. They're not going to be held against you as long as I have your schedule ahead of time, but you're still responsible for the material. So that's a good way for you to stay on top of the material. The first recording that actually worked was last class. So you'll see that's sitting up in Moodle now. I think it's working now. So you should be able to see this class, and we should be able to continue to roll going forward. So Moodle's cleaned up. I had a couple folks contact me and go, I'm looking at Moodle and it says that we should be on chapter 4 already, and there's a bunch of stuff in there for this week, but we're not. So is it right? No, it's not. So I cleaned that up. A couple folks contacted me and said they're having problems with the online sign-in, online assignments. Is anybody having problems with the online piece? Either getting access, or once you get access, figuring out how to navigate. If so,
I was last night, but I'm okay.
You're okay now? Okay. If you do, and you don't want to stand up in front of class and say, I'm having problems figuring it out, come see me right after class, and we can go up or sit here and go through it on the laptop or out in the lobby. Go through it on the laptop, and I'll help you navigate it. The last thing is we are coming up in a couple of weeks. As you recall, there is a Friday where we don't have a class because I'm going to be stuck in a university board meeting. So just want to kind of keep that on your radar. We'll continue to keep it on your radar as we get close. But that means that we've got some compression of material that we're going to need to have to get through, because we've got critical concepts coming, time value money concepts. So I'm going to move pretty rapidly today through the remainder of the material for chapter 2. But before I get started, are there any questions either on the chapter 1 stuff for the quizzes, which is coming due, or on the chapter 2 material so far? Uncomfortable silence. Okay, so I'm gonna start diving in here. I'll do a 2-minute recap of where we were at from last class. You recall last class we dug into ratio analysis. We said each one of these ratios measures different components of the management's performance as it relates to managing various components of the business, whether it's assets or cash or the payables or receivables or any of those things. And so as a result, each one gives a little tiny picture. There's 2 things that you can't do with ratio analysis in a vacuum. The first one is you can look at all the ratios you want for a specific company, but you really need to have them benchmarked against something. So we looked at industry averages and we talked through, okay, this looks high, this looks low, what do you think that means? Then we took a bigger step back and we got through the asset management ratios and the cash management ratios, and we said, hey, we've got little pictures here and there, and this is kind of the little picture piece. Most asset turnover ratios are below industry average, which means the age of the assets is longer than other firms in the industry. Unilite does not appear to be operating as efficiently. But we took another step. We took a step beyond where the book takes you and said, take all these little pictures and paint a bigger picture. What do you think is causing these? Because at the end of the day, as a manager, whether you're in marketing or management or accounting or finance, we not only want to know what, we want to understand why so we can fix it. So does anybody remember, or does anybody want to kind of throw out there what the preliminary story that we started talking about as it pertained to Unilite was from last class? Yes, sir.
They have a subpar product that is being held up by the people we're selling to, retailers, either extending too much or too lenient lines of that they're not getting paid, and as a result, we're not getting paid.
Anybody have anything else to add? Good summation of. So what we saw was what we hypothesized is that Unilite, and I keep wanting to say Uniflight, which is a type of boat. Unilite makes textiles, and they've got a bunch of inventory, more inventory than most folks in the industry. They're having trouble selling it to retailers. The retailers are slow paying, which means they may be having problems selling it to their customers. And that may be indicative that they've got a product problem, or they've got a marketing problem, or they've got, but it's not that they got a finance problem. Finance is kind of pointing at it going, there seems to be an issue here with the operations of the business the operations of the business are likely in product marketing, product design, because their efficiency in production was pretty solid. Any questions on that before we dig into Unilite a little bit more? Okay. So now we're going to talk about debt management ratios. The debt ratio, the times interest earned ratio, we'll talk about why that's important, fixed charge coverage, which is really, if you had to pick one, is probably the most critical of the three ratios. What do you think the debt management ratios are designed to do? I want someone else to answer. Okay, because you're on top of it. How many times that's one way to describe it, and I'll build on that a little bit. Your ability to repay. Ultimately, we borrowed money, and we talked that companies should borrow money. There's an advantage to borrowing money because generally debt is cheap, relatively cheap. And when you deploy it in the form of assets, you expect to get a higher return, and the difference is profit, and that's capital budgeting, and we're going to talk about that later in the course. But this is an indication of your ability to pay that money back, because no one's going to loan you money unless you're going to pay it back. And so we want to make sure that the company is liquid and viable, that it's not going to go bankrupt because it can't pay its bills. So the first one is the debt ratio. And this isn't long-term debt. This is all debt, all liabilities. So total liabilities over total assets. What's that really telling us? It's their leverage. It's how much, and leverage is really how much of their assets, how much of what they own has been paid for by borrowed money versus reinvested money. So in this particular case, they have 430 million in liabilities, 845 million in assets. So 50.9% of their assets were purchased using debt. That's simplistically how to think about it. The industry average is significantly lower, 42%. So in the industry average, you've got 58% of the assets were paid for by equity or reinvestment in the business. 42% were borrowed money. In Unilite's case, nearly 51% is borrowed money, 49% is reinvested. So what that tells us is the debt ratio is above industry average, which suggests it's using more debt to finance its assets than the average firm in the industry. I put suggests in italics because it doesn't suggest crap. It actually tells you. There's no suggestion here. This is like reality. What you're going to find as you look at financial statement analysis is, in some cases, you can say things absolutely. This is or is not. In other cases, it's an indicator of something else. So it's kind of a finger pointing at the moon. It's not the moon. And so suggests in this case is what the book says. Well, it suggests that it uses more debt. No, it does use more debt. There's no suggestion about it. However, if I wanted you to take this and suggest something besides I can read an equation, give me a little bit more of the story. What does this suggest? Yes, sir.
That they put themselves in a hole, so now they're starting to borrow money to try to get them back afloat, and that's why their debt ratio is so high.
Good call. What else?
Their product isn't selling enough, so to make up for it, they're trying to make more other ways, so they're not getting that much income from the other making. But it keeps building and building, not selling.
Good call. What else? Yes, sir.
Don't invest.
Don't invest. Why?
Because it's there. So I'm pretty sure there's there's a general guideline to go by off of comparing other companies. But it's almost 10% higher, right? 8, 10, it's almost there. So obviously it's not performing compared to others, like just even the average company, right? That's not even the best company in the in that industry. But even just compared to out of all the other ones, it's not performing.
Here's a good call. Yes, sir.
I was just gonna say they took out a bigger loan and they thought they were gonna be able to pay.
Maybe not that they thought they were going to be able to pay, but they have taken out some pretty hefty loans recently, have they not?
Yeah.
So we looked at, they bought a bunch of new equipment, they took out some loans. Here's what it suggests to me. It suggests to me that they don't have much of a margin for error. They're more highly leveraged than other firms in the industry. They have more debt than other firms in the industry. If there's a downturn, they still got to pay those bills. They still got to make payments on the debt. And you don't have to pay dividends. You can stop dividends. We talked about dividend. We're going to talk about dividend policy a lot more later. But we talked about dividend policy and the signaling. We could turn dividends off and preserve that cash if you have to. You can't turn debt payments off. So they're a little riskier, and they have a little bit less, or maybe 25, 30% more debt than a typical company. 10% here, but when you take 10% over 42%, it's almost 25% more debt than the typical company in the industry. They're in a little bit riskier position, and more of their cash is going to be devoted to debt service than a typical company, which means if there's a downturn or if they make a mistake, their ability to ride through that or to survive through that is going to be a little bit more difficult. So it suggests that they're a little riskier. It suggests that they've got other calls on cash, which are going to be less flexible in the event they run into trouble down the road. So times interest earned ratio. It's EBIT. Anybody tell me what EBIT is? Good attempt. I heard EBITDA, so you're on the right track. What do you think it is?
Or
Nope.
income taxes.
Close.
Equity before
Earnings before interest and taxes. So it's essentially the earnings that come out of the business before you have to pay the interest, and before you have to pay your taxes, because interest is tax deductible. So you kind of get a tax shield, is what they call it, for interest. And so it's before interest and taxes. That's an important concept. It's an important, all these bizarro names like EBIT, EBITDA, those are important. You're going to see those again and again and again in your career. So they're ones to start committing to memory. EBIT, earnings before interest and taxes. The earnings before interest and taxes for Unilite is $130 million. Their interest expense is $40 million, so it's 3.3 times. Industry average 6.5 times. What does that tell you?
Well, they can pay their interest back to their creditors 3 times over, but if you bring that to a creditor trying to get a loan to pay off the new debt, they're going to say, no, you're half of what the industry was able to pay.
Yeah, so we looked at that last slide and said, okay, they've got nearly 10% more debt than the typical company. This is saying, and with that debt and their earnings, they only have half the coverage. The industry average, they've got a lot more cushion in the event of a problem to continue to make their debt payments than Unilite does. So it's well below industry average, which suggests it's not as able to service its debt as the average firm is in the industry. So we're starting to build this picture now about Unilite, that not only do they have some crappy products that aren't selling, but their balance sheet and their income statement and their debt is going to make it very difficult for them to ride through a downturn. Because if they don't generate cash, they're not going to be able to make these payments. This is a complex formula. And I'm going to walk through the complex formula with you because, as I noted on the first slide when we dug into this, this one's probably the most important. This is the one that gives you an indication of I can keep the doors open or not. Fixed charge coverage, the FCC ratio, is EBIT plus lease payments. Why do you think we factor in lease payments? What if I don't pay my lease? I'll get shut down. I'll get kicked out of my building, or the leasing company will take my, because you can lease equipment. So they'll take my equipment away. They'll kick me out of my building. They'll take my trucks. So this is really, we add it back up here because we're going, okay, we want to see what the total cash available for loan and lease payments are. Yes, sir.
Wouldn't your lease payments be covered in your general operating expenses?
Mm-hmm. They're an expense. We're adding it back here.
Oh, yeah, because that's before.
Right.
Yeah.
So we're going to add it back at the top. And we're adding it back because we're saying, okay, we paid it out in cash. It's in earnings. It's already been taken out of earnings. We're going to add it back. We want to take a look and see how capable are we to actually make these lease payments and actually make our loan payments. Because if we don't make either of those two, we're shut down. As a matter of fact, I will stand here with 20 years of experience in turnaround work and tell you the lease payments are probably going to shut you down faster than the loan payments. You can normally sit down with a bank and negotiate the loan. Leasing companies tend not to be all that friendly. They will come take the equipment because that equipment, when you're leasing something, you're either in a building or it's equipment. The equipment's depreciating rapidly every day. And so it's worth less and less and less the more and more and longer you have it. And so if you're not making payments on it, they're going to take it back. The bank has a general collateral. They'd have to liquidate everything in the company, so you could probably negotiate with them. So we're going to put that over the interest expense because we've got to pay that. The lease payments, because we got to pay that. And the sinking fund payment, 1 over the tax rate. Can anybody explain to me what the heck that last bracketed formula is about? What's a sinking fund and why is it 1 over the tax rate? Any guesses?
Like money they've already put into a fund that you can't get back, you're already spending.
You're on the right track. Okay.
It's just like a fund that I'll come and put money in just in case they go out to sell that money left over.
Not really, but you guys are on the right track. Here's the sinking fund. I'll come back to you.
I was thinking maybe it was money that was loaned to you, and that was slightly like.
Oh, you're so close. No. But you're on sinking fund payments. There's a different way to describe them. The reason I have them as sinking fund payments in here is because that's how the book calls them. And in many cases, that's what they may look like. I'll talk to you about what a sinking fund is. It's basically principal repayments. Required principal repayments on the debt. So you've got the interest charges on the debt, and you got principal repayments on the debt. So why do you think it's 1 over the tax rate?
After you pay your taxes.
Perfect. You pay back debt after tax. So you actually need to have more cash. You've got to pay tax on that, and you've got to pay back the debt. A sinking fund, technically, when you issue bonds, let's say I issue $100 million of bonds, and I say I'm going to pay back those bonds in 20 years. So 20 years from now, I'm going to pay back the bonds. Some bonds have what are called sinking fund provisions, which basically say that you've got to put 1/20th of the principal repayment into a segregated account and have it sit there and build up over time so that you've got enough money to pay off the bonds in 20 years. You can't have access to it. It's held by a trustee, but you're slowly building this stuff up so that it's a guarantee that you're going to be able to make the repayment in 20 years. The difference between a principal repayment and a sinking fund is a principal repayment, you pay back the loan now, and the loan amount goes out. So you go from 100 million to 95 million. A sinking fund, it keeps the 100 million out all the way to that 20-year point, and it builds up a separate bank account to pay it off. And so that's a sinking fund. So we use a sinking fund in the book, but you can think about it as principal repayment or sinking fund. From a finance perspective, they're treated largely the same for trying to figure out if I got enough cash to pay the bills. It's kind of like yeah, it's an asset because it's cash, it's building up, and it's going to offset your debt. Yes, ma'am.
Why would they want that? Like, why wouldn't they just want to just pay it off? Why would you want a separate account?
That's a great question. Who do you think wants a separate account? The people loaning you money. Why? They want, not only do they want their money back, but what else do they want? They want the interest. So what happens is if you pay it back, they get less interest every year because you're paying the loan down every year. And these guys go, no, I'll lend you $100 million, and I want it back in 20 years with interest. And I want my $100 million back in 20 years, and I want you to pay me 8% interest for the next 20 years. I don't want you to pay me 8% interest on $100 million this year, 8% interest on $95 million next year, 8% interest on $90 million the year after. I want on the whole thing for the entire amount. But I also want to make sure you're going to pay it off. So you stick it over here in this sinking fund, and you can earn interest on it. Normally bank interest, so you might get 0.25%, 0.5%, 1%, put it in CDs. And on the other side, the investor gets to make the spread. So that's why they do it. The company would rather do what? Generally pay it down this year. So in this particular case, EBIT, which is earnings before interest and taxes plus the lease payment amount, gives you $140 million of available cash. Over $40 million of interest charges, $10 million of lease payments, and then there's an $8 million principal repayment. The effective tax rate is 40%. Under the new bill, it's going to be, under the new tax law, it's going to be 20 something, but 40% here. So that's over 63.3, which is 2.2 times. So once you factor the leases in, it even looks worse. I'm like, holy crap, they don't have much room at all. Industry average 5.8 times. Tell me the story. Tell me the story. What do you see? See a business going under. It's just a matter of time. Way below the average. So I'll definitely agree with way below the average. I would not say the business is yet ready to go under because it's still able to pay its bills. But I'm getting pretty nervous. It may be time for new management. It certainly may be time to really take a good hard look and go, all this investment that they made this last year in this new product, which doesn't seem to be selling well, is that something we're going to continue with? So is that a timing problem? So the market's just not ready for it. It's going to all of a sudden take off like a rocket ship? Or does that mean we got a garbage product and we're never going to be able to bail out of this thing? So the conclusion, debt ratio is higher than the industry and the coverage ratios are lower than the industry. It's got more debt and it's less able to pay than most other companies in the industry. This is probably an understatement. It's going to find it difficult to borrow additional funds until its core debt position is improved. Where do you think, if it needed to borrow money, where do you think it's going to borrow the money from now? No, banks won't lend the money.
That would happen. You got like a bond or something. That's stock issue.
It could be stock issue, which isn't a borrow, but that's probably where they're going to have to raise money as equity. Junk bonds. What are junk bonds?
Bonds from companies in this position.
Yeah, it's where they go charge 15, 12, 15, 18% interest like a credit card to go issue a bond to back this company. Where else are they going to borrow money? Where's the cheapest place they could borrow money? Not the mob, not China. They're vendors. They won't pay the payables. They'll start slowing payables down. Remember, folks are taking 45 days to pay these guys, right? So, and our hypothesis was, well, that's probably because the folks they sold to are having problems getting their inventory sold. And so it's slowing down payments. What would I do as the manager? I would then slow down payments to my vendors too. I'm borrowing money from them. When you think about it, it's accounts payable, right? That's a loan. It's a very short-term loan from your vendors because they've shipped product. They want money. The cheapest loan you're going to get is slowing down your vendors, slowing down payments, because your interest rate's normally relatively low, 0, or maybe 1% per month, 1.5% per month. Last set of ratios, profitability ratios. Profit margin, net profit over sales. 54 million in net profit, 1.5 billion in sales, 3.6%. The industry average is 4.9%. What does that tell us? What else?
I'm having to drop the prices because people aren't buying it, so they're not making as much money after stuff.
I love that. Because that's getting more to the why. Why do you think that this is that much lower? Well, we're starting to paint this picture, right? They've got high inventory, they got low receivable, or they've got high receivables, they've got low cash position, they've got a lot of debt, and their profit margin is lower. But we also know when we looked at the ratios for their operations that they're operating pretty efficiently. Their manufacturing operations are pretty efficient. And so it's probably a pricing problem too. And it may be a pricing problem because a product is bad. And in order to actually move the product that they've got, they're discounting. And so it gives you something to kind of go, okay, I might need to take a deeper look at that. Anything else you guys might see based upon what you either remember or can see in the book? Let's go to the next one.
Does it cost too much?
It could cost too much to make. Now, again, that could be a price problem on the front end, so you're selling for less and you're not getting enough margin, or you're not as efficient in the production. And so it costs too much. But you know your margin's compressed. You know the amount you're making is compressed.
I got it.
Okay.
They're making a product that they're not able to. So aside from the reason their product is bad is because they're trying to operate in a market they're not built or ready for.
That's an entirely possible and probable hypothesis. So now let's look at return on assets. Net income over total assets. 54 million in net income, total assets 845. Gives you 6.4% return on net assets, or return on total assets, excuse me. Industry average is 10.3. What's that telling us? Yes, sir. They're not using their assets as effectively as other companies, And where are their assets out of line, based upon the analysis we did last class? Inventory. Yeah, what they're selling, the inventory, where else? Inventory and accounts receivable. Inventory and accounts receivable are off. And so that's one of the areas where you're going, okay, because we looked at property, plant, and equipment, remember, and that seemed right about online. So inventories are off and receivables are off, which again is continuing to reinforce that same story about we've got some product problems. We've got some pricing problems. We're probably discounting, or we're not able to get the margin that we had expected, so it's costing us a little bit more than we had expected, and we're not able to get the price we had expected to be able to get this stuff sold. Return on equity. This is important. Why? Why would an investor care what the return on equity is?
How much they make off the money that they invested.
Yeah, I heard it from a couple different places. This is the return to the investors. This is the money that, hey, I put money in the company, I've invested in the company. This is what essentially I'm making. And part of it's going to be paid out to me in dividends, and part of it's going to be reinvested in the company. And so we talked a little bit about, you can compare this to the cost of debt, and you want this always to be higher than the cost of debt, otherwise you're in real trouble. But if you look at this, you go net income 54 million, common equity 415 million. We got a 13% return on equity. The industry average is 17.7. What is that telling you? Are they losing money? They're not earning as much as they could elsewhere. And so, Mr. Chisholm, right?
Yeah.
Okay, so what Mr. Chisholm has indicated is probably part of the reason for their stock price going down. Because if I wanted to invest in a textile company, why would I pick this one? I probably wouldn't. Unless I felt like this was a timing issue with that product and it was going to take off like a rocket ship and this was just an investment that was a short-term problem. Otherwise, I'd be going, hey, if I want to invest in textiles, I'm going over to this other company where I can get 17.7% on my money, not 13%. Which means the stock price will continue to come down. Conclusion. The operating results have suffered because of the poor liquidity position, poor asset management, poor debt position. Okay, that's obvious. But what isn't obvious, but what you guys have been pulling apart for the last 2 days, is the why behind this. If you were a hardcore financial analyst, and I've only got 1 or 2 of you in the room that are finance majors, kind of pull a hat on and you go, okay, I'm going to do all this analysis, and I'm going to come up with all these ratios, and it's going to be all cool. That's nice. And you can compare it to a bunch of different companies, and you can go, this one's valued more and that one, and we should invest here or there. Most of us in the room are going to be working in companies, in operations. We're going to be trying to make the companies that we work for operate to their best, operate to maximize shareholder return. And so beyond I can calculate this, you guys have started pulling apart the whys. You started pulling apart okay, it's probably a product problem. We may have a problem with our credit and who we extend credit to and how they repay. The whys are far more important. As we go through the class, a lot of what we're going to end up with in the class on the midterm and on the quizzes are the whats. You're going to calculate this. Tell me this, calculate this, give me the best example of X. When you get to the final exam, when you get to the real world, where this actually matters, the why is far more important. Your hypothesis around why is it behaving this way is far more important. Credible hypotheses, which you guys are coming up with, are far more important because that gives you things to look at as a manager to kind of dig into and try and understand why the company's performing the way it's performing and fix it. At the end of the day, it's gee whiz to know that it's bad. It's far more important to know why it's bad and how to fix it. Market value ratios, price to earnings ratio. PE ratio is the price per share over the earnings per share. So we saw that Unilite is trading at $23 a share. It made $2.16 a share, 10.6 times. The industry average is 15 times. The PE ratio is below the industry average. What does that tell you? It says it's a riskier investment than other firms in the industry. You guys have not yet, we haven't gotten into stock price theory, so which we'll get into. But forget stock price theory. What's common sense theory tell you about why is the PE ratio? Let me flip this around. If Unilite was trading at the industry average, about roughly where would the stock price be? Be around $31, $32 a share, right? 15 times $2.16. It's at 23. So what does that tell you? How do investors really think about this company? They're not. They're basically going, and when we talk about finance, what are we talking, and when we talk about, this is a reflection of what?
It's perceived future value.
Perfect. This is the $23 is a perceived future value. It's a present value, and we'll talk about this next week. It's a present value of the expected future cash flows to the investor. And the investor's going, if this was a normal company in this industry, I'd pay $32 a share. It's not, it sucks. It's only worth $23 a share because I'm looking forward. I'm looking at all the data that I've got. I'm asking questions, and the market says the future opportunities for this company are significantly worse than its peers. And so I'm out. Demand is low for the stock price goes down to reflect the fact that the future prospects are worse. Market to book ratio. Market price, $23. Book value. What's book value? Kind of. Not fair market value. It's a balance sheet value of all the assets minus the liabilities. So what you got is the book value per share is $16. The market price per share is $24, 1.5 times. Industry average 2.5 times. Why would you pay 2.5 times the book value for a company's assets? So if someone had a piece of equipment in a little company, and that piece of equipment was worth $10,000, why would you pay $25,000 for that?
They were going about it in the 1800s, and it's worth billions.
There's some of that, which if you didn't hear, Standard Oil bought it, 10 years ago, 15 years ago, the property or the equipment or the building is actually worth a lot more than the book value. And that happens all the time. What else?
I was gonna say that maybe you pay something that you think they're having a rough patch here, but you expect them to do well.
Exactly. We're looking at the future. And we're going, okay, I'll pay $23 for $16 worth of assets because I expect it to get me a lot more money in the future. In this particular case, they're going, it's almost at the point where they're going, the company's worth the book value of the assets is what we're trading it for. We're not expecting much upside here at all. As a matter of fact, back in the 80s, it's become less common because the 80s kind of flushed it through the system. Financial analysts would get into companies and they'd look for two things. They'd look for where this was off because they had bought property or something like that back in the 1800s that's carried on book value, and so there's undervalued assets. They'd buy the company, split it up, and sell it. Or they look for companies where they go, it's 1.4 times here, it's 2.5 times here. I'm going to pay $23 a share, and I'm going to fix the product problem. Because I know what the problem is. It's a product problem. And I know how to fix it. And so I can get it up to here, and I'm going to make that profit. That's the takeover mentality. That's when we go back to the first week, and we talk about what can shareholders do to maximize value. They can sell the company. They can fire the managers, get new managers who can go, I can get you up to 2.5 times. We got to do this, that, and the other thing. The understatement of the week. Investors are not excited about the future prospects of this company. The last thing I'm going to cover, and this is a complex thing, it takes all this stuff and puts it into a big, bizarro calculation. We're going to touch on this over and over and over again, so I'm not going to bury you in it, although you're going to get some questions on it. The DuPont equation. It was developed about 100 years ago, we're darn close to that now, to really take a look at all the components of how a company works. Take each of these chunks of ratios and try and take each of those pieces that we've been pulling apart and going, let's take this and add it to this piece and add it to this piece and create the picture. The DuPont ratio essentially shortcuts that and creates the picture for you quickly, but it's complex. It takes the profitability, it takes the expense control, and it takes the asset utilization and says, let's look at all that together and come up with the various levers that we can pull to improve performance. So it looks at return on assets, which is net income over sales, times sales over total assets. So it goes, okay, 54 billion over 1.5 billion. And then you've got times 1.5 billion here over 845 million. 3.6% times 1.77 times. So your asset turnover, your net income gives you 6.4%. And you're like, great, that's my return on return on assets. I can calculate that other ways too. Yes, you can. It's not that hard, but this shows you the various components. Then you've got return on equity. You take the return on assets number you just calculated, 6.4%, or you can recalculate it this way, net income over total assets, times the equity multiplier, total assets over common equity. So essentially, what do you have, and how much of that was paid for by common equity? 2.036%, or 2.036 gives you 13% return on equity. Yes, sir?
What are the return on equity and return on assets equations out two things as well?
Because you're looking at each of the operating components. When we looked at the big ratios, the ratios that we've just walked through, we're essentially, the DuPont analysis essentially takes each of those components and shows how they interrelate. Because you can calculate this directly. We've done that. It just shows the various pieces, the operating pieces that go into or that impact those calculations. Then you've got return on equity. Profit margin times total asset turnover times the equity multiplier. Again, each of those components laid out, you come back to 13%. But you're now looking at each of the pieces. Is profit margin off? Are my assets off? Is my equity return off? What is causing the return for the company to be lower than expected? Here's your caveats. Industry average isn't magical. Comparison of industry averages is difficult if the firm operates many different divisions. So if Unilite is different than a lot of other textile companies, inflation distorts balance sheets, which we just talked about. You can buy stuff years and years and years ago, and it's going to show really good asset utilization, but it might be obsolete equipment. And seasonal factors can distort ratios. We talked about that last class. Maybe they have a bunch of stuff at Christmas, their year end is timing it. If you have any questions on things that are, as you're going through stuff this weekend, hit me up by email. Otherwise, have a great weekend. I'll see you back here Monday.
No.